The median price of a home in America right now is $348,800. Not in Manhattan, not in Malibu, the middle, the average city, the average block, the average Tuesday. You are lying on a couch in an apartment that costs you $1,470 a month, and you are running the math that refuses to work. You have run it 3 times this week. Same numbers, same dead end. You bring home $54,000 a year. You have $11,200 saved. Your credit score is 694. Your student loan hits on the 15th like a bill that was born knowing your name. The house you grew up in, the one your parents bought in 2001 for $148,000, is now worth $390,000. You know this because you check Zillow at night the way other people scroll Instagram. You check it the way you would check a bruise, not to feel better, just to know whether it's gotten worse. You tell people you are saving up. You tell yourself you are being patient. But at your current rate, patient means 4 more years before you have enough for a down payment on something that might cost more by the time you get there. The market is not waiting for you. It has never waited for anyone. Here is what most people do not understand. They are not stuck because they are not smart enough. They are not stuck because they do not work hard enough. They are stuck because they are optimizing for comfort when the situation demands they optimize for position. The two feel almost identical from the inside. They are not the same thing. You find a forum post at 11:30 on a Wednesday night. Some guy, no verified credentials, no blue checkmark, just a story about a house he bought in Columbus in 2019 for $174,000. He put $8,700 down, rented it out. The tenant covered the mortgage. 4 years later, he refinanced, pulled out $41,000 in equity, used it as a down payment on a second property. You read it 4 times. The math is not complicated. The math is almost embarrassingly simple. What is not simple is that your entire life you were taught that debt is danger and a mortgage is a burden. And here is this man describing debt as an engine. Something shifts inside you, not a feeling, a framework. Rule 1, at 0, your obstacle is not money. Your obstacle is that you are thinking about real estate the way a renter thinks about it, as a cost. The moment you see it as a vehicle, the whole road changes. You start studying your local market the way you once studied for final exams, except this time you actually want to know. You learn what cap rate means. You learn cash-on-cash return. You learn what DSCR stands for and why a lender cares about it more than your W-2 when you are applying for an investment mortgage. You are not ready to buy yet, but understanding is always the purchase before the purchase. The deal does not come from a website. Your coworker mentions it offhand in the break room. Her aunt is selling a duplex, wants to be done with it, needs to close before the end of the year. It is a 1960s brick building in a working-class neighborhood that has been quietly changing for 2 years, 2 miles from a hospital that just announced a $200 million expansion. She is asking $218,000. Both units are rented. Combined rent is $2,100 a month. You run the numbers on a napkin in your car. You run them again on a spreadsheet at home. You talk yourself out of it for 4 days. Then you make the call. You put 20% down, $43,600. That takes your savings account to 0. You feel the way people describe jumping from planes, terrified and completely awake at the same time. Your investment mortgage rate comes in at 7.1%. Your monthly payment is $1,174. Your units bring in $2,100. After taxes, insurance, and a $200 monthly maintenance reserve, you clear $486 a month. That is not life-changing money. You know it is not life-changing money, but 2 people you have never met are paying down your mortgage every single month. 2 strangers are building your net worth 1 payment at a time. That is a different kind of income than a paycheck. It is something you feel differently in your chest. You do not quit your job. You do not tell everyone. You fix a water heater at 7 p.m. on a Thursday when the tenant calls. You learn what a P-trap is. You learn that a property manager will cost you 8 to 10% of gross rents, and at your size right now you cannot give that margin away, so you manage it yourself. Every repair teaches you something no textbook includes. The tenant who pays 2 weeks late but always pays. The neighbor who calls about the gutters. These are not problems, they are tuition. 18 months later, the duplex has appreciated. A coffee shop opened on the corner, then a CrossFit gym, then a small brewery. The hospital expansion broke ground. Zillow shows $261,000. You have $46,000 in equity. You have saved $14,000 from your job in that same time. You are 29 years old. Your net worth is $68,000. That number was 0 2 years ago. Rule 2. The house someone else pays for is the only house that makes you richer while you sleep. Everything else you own is just furniture. You refinance the duplex, pull out $28,000 in equity. Your monthly payment increases by $188, and it feels wrong in your gut the way it always does when you access money you did not think you had. But you understand now what that guy in Columbus understood. You are not spending equity, you are repositioning it. You use $22,000 as a down payment on a single-family rental, a 1,400 square foot ranch house in a suburb where the median rent for that size is $1,480. Purchase price, $197,000. You close in 43 days. Before that closing, you spent 3 months making yourself a better borrower, paid down a card, let 2 hard inquiries age off, moved money into the right accounts at the right time. You learned what lenders actually look at, then looked at yourself the way they would. You now hold 3 units. Combined rent is $3,580 a month. Combined mortgage is $2,190. After reserves and insurance, you net $847 a month. Your day job still covers your life. The real estate runs separately. It is a machine you are building on the side, and it runs whether you are watching it or not. You are 31. Your portfolio is worth roughly $458,000. Outstanding loans, $302,000. Equity, $156,000. You check that number the way you used to check your bank balance late at night, not from anxiety this time, from something closer to disbelief. You find a 6-unit apartment building, built in 1971, all units occupied, located in a mid-sized city where vacancy sits at 4.2% and rents have risen 2.9% annually for 3 straight years. Asking price, $640,000. Net operating income, $41,200. That works out to a 6.4% cap rate, which compares favorably to the national apartment average of 5.7% in 2025. You spend 6 weeks underwriting it from every angle. You find things the seller did not disclose. You use those findings to negotiate $38,000 off the price. You close at $602,000. You bring in $82,000 from a private money lender you spent 8 months building a relationship with, coffee meetings, quarterly updates, 2 dinners where you never once asked for anything. The lender earns 9% on their capital. You get the building. Everyone wins. This deal changes the nature of what you are doing. Before it, you were a person who owned rental houses. After it, you are operating a small commercial real estate business. The distinction is not cosmetic. The financing is different. The insurance is different. The tenant profile is different. The management structure is different. For the first time, you hire a part-time property manager. You pay her $340 a month. She is worth 3 times that. Rule 3. Below 5 units, you are a landlord. Above it, you are building a business. The moment it becomes a business, your decisions change. The language changes. The leverage changes. The way banks look at you changes. Your combined portfolio now generates $7,140 in monthly gross rents. After expenses, debt service, and management, you're clearing $2,190 a month. For the first time, your real estate income crosses 5 figures in a single year. You file taxes differently now. You have a CPA who works exclusively with real estate investors. She walks you through cost segregation. You learn that the IRS allows you to depreciate a residential rental over 27.5 years. You learn how to accelerate that. You learn what Schedule E is and how it has been reshaping your tax liability in ways you did not fully grasp before. The money saved on taxes goes back into the machine. You are 34, 9 units. Total real estate value, $1.1 million. Outstanding debt, $714,000. Equity, $386,000. You have crossed $1 million in real estate assets. The number does not land the way you expected. It lands like weight. The weight of having built something that started on paper and became brick and became a number you never let yourself fully believe in. You feel all of that, then you get back to work. A developer calls. He overextended during a construction boom and needs liquidity. He is selling a 24-unit apartment complex in a secondary market you have followed for 2 years. Growing population, expanding job base, the kind of place where remote workers relocated during the pandemic and simply never left. Asking price, $2.8 million. Cap rate, 5.9%. Occupancy, 91%. You know this market well enough to know that 2 operational changes the current owner has not made will push occupancy to 96% within 14 months. You can state those numbers without checking your notes. You cannot do this deal alone. You have never syndicated anything. You spend $4,000 on an attorney who has. You bring in 3 investors from your network, people who have capital but not time, people who have watched you operate for years, who have seen your track record rather than just heard about it. You raise $680,000. You close on the 24 unit. You are the general partner. This is a different version of you than the one who was afraid to call a woman about a duplex 6 years ago. Rule 4, the deal you enter matters less than the terms you negotiate to enter it. Equity, cash flow, and control are 3 separate things. Most investors think they want cash flow. What they actually want is control. Understanding the difference is the difference between building wealth and simply building income. At 37, your portfolio holds 47 units across 6 properties. Annual net operating income, $310,000. After debt service, you net $148,000 from real estate. That number has crossed your salary. You do not make an announcement. You tell your spouse over dinner on a Tuesday. She already knew it was coming. She has watched you run numbers every weekend for 7 years. That night you have a 3-hour conversation about capital allocation, which properties to sell, how to manage leverage in an uncertain rate environment. It is one of the most important conversations of your life. It happens at a kitchen table. Nothing remarkable going on outside. You sell your first duplex, the one that started everything. Your adjusted basis after depreciation is $47,000. You sell for $319,000. You execute a 1031 exchange and roll the proceeds into a 32-unit in a market where rents are 14% below comparable cities with identical economic fundamentals. The market has not caught up yet. You believe it will. You are buying time as much as you are buying real estate. Your net worth crosses $2 million. It feels less like an arrival than a checkpoint on a much longer road than you originally imagined. You start spending time around operators who own 200 units, 400 units. You study how they think, not what they own. The patience is different. The pace is different. They are underwriting deals years before those deals become available. They are building relationships with sellers before sellers know they want to sell. You raise a small fund, $4.2 million from 12 investors who have watched you work for a combined 11 years. You deploy it across 2 value-add multifamily acquisitions in adjacent markets. You bring on a full-time asset manager. You implement property management software that your 9-unit portfolio never needed, but your 160-unit platform absolutely does. The distinction between investor and operator has fully collapsed. You are both. The machine is no longer something you built on weekends. It is an institution, small but real. Rule 5, at $10 million in real estate holdings, your reputation becomes a financial instrument. Brokers bring you deals before they list them. Lenders call you. Sellers take your offer over a higher number from a stranger because they know you close. That trust was not bought. It was accumulated at the rate of one kept promise at a time, in markets nobody else was watching. At 43, your portfolio holds 218 units across 4 markets. Total asset value, $31 million. Debt, $19.4 million. Equity, $11.6 million. Net worth including everything outside real estate, $14.1 million. The exact number is known to your attorney, your CPA, and your spouse. That is it. You have stopped measuring yourself by it, not because it does not matter, because the number stopped being the interesting part. The structure is the interesting part. The velocity is the interesting part. The way capital compounds and creates options that did not exist before, that is what holds your attention now. You get into a 300-unit ground-up development. You have never built from scratch. You hire someone who has. You bring in an institutional equity partner. You learn more in the 18 months it takes to break ground than in the previous 5 years combined. You lose 6 months to a council vote that goes the wrong way. You do not panic. You do not sell. You redesign, come back, and represent. The project moves forward. The building delivers. 94% leased in the first 6 months. The same city that fought you is now using your building in their economic development brochures. You do not feel vindicated. You feel focused. There is already another deal on your desk. Your annual distributions to yourself are $1.1 million. Most of it goes back in. You live in the same house you have lived in for 11 years. You drive a truck you bought in 2019. You take your family on one meaningful trip a year. This is a choice, not a limitation. The gap between those 2 words is, in a very real sense, the entire point of everything you have built. Rule 6, above $50 million, you are not just an investor. You are infrastructure. Cities plan around what you build. Lenders design products around what you need. The market does not overlook you. It incorporates you. At 51, your portfolio spans 700 units across 9 markets. Total real estate value, $87 million. Equity $39 million. Net worth $52 million. You have a staff, an acquisitions director, an in-house CFO managing 13 LLCs and 2 operating funds. You sit in a room with 7 other principals. Between those 7 people, $2.1 billion in real estate assets. The conversations are short. The decisions are fast. The capital moves in amounts that would have seemed fictional to the version of you who was checking Zillow from a rented couch. You now mentor 2 people who remind you of who you were at 27. You do not give them inspiration. You give them math. You show them the actual numbers from your first duplex. The $486 a month. The 7.1% rate. The exact moment you handed someone the keys to an apartment you owned and felt that quiet, strange kind of pride. You tell them what no one told you. Real estate rewards the specific. The person who studies one market, one asset class, one set of fundamentals, until they understand it in their sleep, that person is still at the table 20 years later. The person who is waiting for the perfect conditions has been waiting this whole time. Right now, somewhere in the city, there is a 27-year-old lying on a rental couch. Their apartment costs $1,470 a month. They are opening Zillow, looking at a home priced at $348,800 and running the math that will not work, telling themselves they are being smart, telling themselves they are waiting for the right moment. The 30-year fixed rate is 6.37% this week. It was 6.62% a year ago. It might go lower. It might not. The market is not pausing for anyone's savings account to catch up. The question is not whether the moment is right. The question is what the next 20 years look like if you keep waiting for it to be. The machine does not run on inspiration. It does not run on confidence. It runs on one small, terrifying, specific decision. A duplex, a phone call you almost did not make, a down payment that takes you to zero. After that, someone else starts paying your mortgage. After that, the math starts running in the right direction. After that, you begin to understand what the word asset actually means when it belongs to you, when it was built by your decisions, when it runs on a Tuesday afternoon while you are doing something else entirely. It always starts at zero. It always will.